If I could pick just one growth ETF for 2026, which one would it be? That's what we're figuring out today, and we're not going to do it emotionally or blindly. We'll break down real numbers, real performance, and what actually makes sense heading into 2026. Now, growth ETFs are hot again, especially after 2024's pullback, when a lot of investors shifted back towards safer dividend plays. But 2025 changed the mood. Tech rebounded, innovation stocks came roaring back, and AI became more than just a buzzword. It's now an actual profit driver. So the question is, which single growth ETF captures that long-term momentum without exposing you to crazy short-term risk? To answer that, I'm looking at three of my favorite contenders: SPMO from Invesco, VGT from Vanguard, and QQQM, the low-cost version of QQQ. Before we dive into them, here's the idea. If you want to build wealth through growth ETFs, you need one that's 1. Diversified enough to survive downturns, 2. Exposed to innovation leaders, and 3. Has a low expense ratio so your gains actually compound. Let's start with each one. This ETF tracks the SP500 Momentum Index, basically the stocks in the SP500 with the strongest recent performance trends. It's kind of like the market's hot hand strategy. It picks what's been working best and rides the wave until the trend breaks. Expense ratio? Just about 0.13%, pretty reasonable. As of late 2025, SPMO was up roughly 28% year-to-date, making it one of the better momentum plays in the SP500 universe. Top holdings include Nvidia, Broadcom, and Meta, each carrying around 7 to 10% weights. In short, SPMO rewards recent winners and rotates regularly to stay on the strongest momentum names. But there's a catch. It's volatile. If momentum shifts, performance can swing hard both ways. Own personality. SPMO. Momentum-driven, high-risk, high-reward, and more active rotation. VGT. Sector-focused, tech-dominant, low-cost, long-term compounder. QQQM. Diversified growth exposure, slightly higher fee, but broader base. So now that we've met our three contenders, SPMO, VGT, and QQQM, it's time to get serious. Which one actually delivers the best mix of growth, consistency, and risk control heading into 2026? Let's start with performance, because numbers don't lie. Over the past 3 years, 2022-2025, here's what we've seen. SPMO returned roughly plus 35 to plus 137% total, rebounding strongly in 2025 after a rough 2022. VGT came in around plus 142% total for the 3-year period, thanks to the AI-driven tech rally. QQQM posted about plus 139% total, benefiting from its broader Nasdaq exposure, but slightly diluted compared to pure tech VGT. Now stretch that to 5 years, 2020-2025. SPMO, around plus 168% cumulative. VGT, a monster, roughly plus 192% cumulative. QQQM, about plus 180% cumulative. So in sheer growth, VGT wins. It's not even close. But performance alone doesn't tell the whole story. We need to look at how these returns were earned. Here's where it gets interesting. SPMO, being a momentum fund, trades in and out of the market's hottest names every quarter. That rotation means higher volatility. It can outperform when markets trend upward, but it also whipsaws hard in corrections. Its standard deviation sits close to 23%, which is on the high side for large-cap ETFs. VGT, meanwhile, has volatility around 20%, still high but consistent. Because tech as a sector can drop 30% fast when interest rates spike, but it also recovers fast. QQQM, with its broader exposure, lands near 18% volatility, the lowest among the three. It's smoother, less whippy, and tends to hold up slightly better when markets cool off. So if you hate gut-punch drawdowns, QQQM might feel more comfortable. If you crave pure upside, VGT is the adrenaline rush. And SPMO, it's the gambler's play. If you get the trend right, it prints money. If not, it punishes you fast. So if your plan is buy, hold and forget, VGT is the one to ride through 2030 and beyond. The downside? It's concentrated. When tech corrects, it hurts. But long-term history has rewarded staying invested in innovation. If you're the kind of investor who wants growth but also wants to sleep at night, QQQM is where you look. Think of QQQM as the more level-headed cousin of VGT. You're still getting tech exposure, Apple, Microsoft, Nvidia, but also consumer and communication giants like Amazon, Meta, and Costco that smooth out volatility. It's still growth-focused, but not as laser-narrow as VGT. And because QQQM tracks the Nasdaq 100, you get exposure to the best non-financial companies driving innovation. For someone building a retirement portfolio or long-term Roth IRA, QQQM makes perfect sense. It gives you high-quality growth without the whiplash of a single-sector ETF. Expense ratio is just 0.15% and it's tax-efficient, perfect for buy-and-hold investors who don't want to mess around with trading. So if your strategy is set it and check once a quarter, QQQM keeps you in the game, with less heartburn. Now let's talk about the high-octane pick, SPMO. SPMO isn't for everyone. This ETF chases momentum, meaning it buys the stocks that have already been outperforming and dumps the laggards every quarter. That's great when markets are trending strongly upward, like 2025's AI and chip rally, but it can turn ugly when leadership changes fast. This ETF works best as a satellite position, something you use to juice returns around a core portfolio of broader ETFs like VO or QQQM. You don't build your foundation with it, you enhance your performance with it. If you're comfortable managing your own portfolio, monitoring trends, and taking profits periodically, SPMO can be a powerful tool. But if you're a passive investor who doesn't rebalance often, it'll probably frustrate you with sudden swings. Let's say you've got $10,000 to invest in 2026. Here's one smart way to blend exposure without going all in on risk. 60% in VGT, your growth engine, 30% in QQQM, diversification and balance, 10% in SPMO, momentum kicker for upside. That mix gives you 90% exposure to long-term innovation and 10% tactical exposure to trend shifts. It's like owning the highway and also a turbocharger when you need a speed boost. Rebalancing once or twice a year keeps it optimized, no day trading required. Let's be real, even the best ETF comes with risks. Valuations. Tech stocks are still trading above long-term averages. If earnings slow or rates rise unexpectedly, you'll feel it. Sector concentration. Especially with VGT, your eggs are all in one basket, a strong one, but still one. Market rotation. Momentum funds like SPMO can underperform sharply when leadership rotates to defensive sectors like healthcare or utilities. Interest rate. Sensitivity. Growth stocks hate rising yields because their future earnings get discounted more heavily. That's why even with conviction, balance matters. Holding some defensive or dividend exposure on the side, like SCHD or VOO, can make your overall portfolio more stable through cycles. Here's what most people don't talk about. Growth investing is psychological. You'll watch your ETF climb 40% one year and drop 25% the next. And if you panic sell at the bottom, you've already lost the game. The investors who win with VGT, QQQM or SPMO are the ones who hold through fear, who understand that volatility is the price you pay for long-term wealth. So before you pick your ETF, know yourself. If you can stomach swings, lean into VGT. If you prefer calm compounding, QQQM is your partner. If you like chasing trends, SPMO can add a thrill. But whatever you do, stick to your plan. Heading into 2026, my conviction still leans toward VGT as the single best growth ETF. Not because it's the flashiest, but because it's consistent, efficient, and deeply tied to real innovation and profits. But I also respect that every investor's story is different. If you're young, building wealth, and can handle some bumps, Go all in on VGT. If you're mid-career, balancing growth and stability, tilt toward QQQM. If you're tactical or adventurous, sprinkle some SPMO and enjoy the ride. Because in the end, the best ETF isn't the one with the highest returns. It's the one you can actually hold through every market storm without losing sleep. SPMO doesn't get the same spotlight as VGT or QQQM, but make no mistake, this fund has one of the smartest factor strategies in the game. It combines momentum and value tilt, meaning it rotates into companies that have been performing well and are still attractively priced based on fundamentals. So while everyone's chasing Nvidia and Tesla, SPMO might quietly pick up names like Eli Lilly, Broadcom, or Prologis when they're showing momentum but not overhyped. That makes SPMO the most balanced growth ETF of the three. Its risk-adjusted returns often surprise investors, less volatility, smoother drawdowns, and higher Sharpe ratio compared to pure tech ETFs. But here's the catch, SPMO doesn't explode upward in bull runs. It climbs steadily. It's the ETF for the disciplined investor who doesn't want sleepless nights over 10% daily drops. So if your 2026 goal is to grow wealth consistently while managing volatility, SPMO deserves real respect. It's not sexy, but it's solid. VGT is for those who believe that innovation will continue to dominate the next decade. Artificial intelligence, cloud computing, digital payments, cybersecurity, all these sectors run through VGT's veins. With names like Nvidia, Apple, Microsoft, Broadcom, and Adobe, this ETF is a pure growth machine. And here's the thing, despite tech volatility, long-term investors in VGT have been rewarded massively. Over the last 10 years, VGT has averaged around 18 to 20% annualized returns. Yes, it's heavily concentrated. More than 50% of its portfolio sits in just a handful of mega-cap stocks. But those names are cash flow giants that dominate global markets. In 2025, VGT trades around $540 per share, and if you believe AI, 5G, and data centers are still early in their adoption curves, this ETF might be your best shot at catching exponential upside. The downside, volatility. When tech dips, VGT feels it first and hardest, but when it rebounds, VGT rebounds like a rocket. So it's not for the faint of heart, it's for the believers in innovation. QQQM tracks the Nasdaq 100, which includes the top 100 non-financial companies listed on Nasdaq. Basically, it's your gateway to companies like Amazon, Nvidia, Meta, Apple, and Tesla without the heavier expense ratio that QQQQ carries. It's cheaper, just as efficient, and often preferred by long-term investors who don't trade frequently. If you're someone who loves QQQ but wants to save a few bucks in annual fees, QQQM is a perfect alternative. In 2025, QQQM trades around $204–208 per share, depending on the market day. It's diversified across sectors, but tech still dominates, around 50% of the weight. QQQM is less aggressive than VGT, but more dynamic than SPMO. It's a middle ground ETF, balanced enough for a retirement portfolio, but still aggressive enough for a long-term compounding strategy. So now comes the final call. If I could pick just one growth ETF for 2026, which one would I choose? Here's the honest truth, and all three are great, but they're not meant for the same type of investor. Let's summarize it this way. If you want maximum growth potential and you can handle volatility, go with VGT. It's the most explosive, innovation-driven, AI-fueled growth ETF on the list. Short-term pain, long-term gain, that's VGT's story. If you want growth with less risk and smoother performance, pick SPMO. It may not make headlines, but its smart factor approach can outperform when the market gets choppy. It's your steady marathon runner. If you want balanced growth and PE. If you want balanced growth and passive exposure to the best of Nasdaq, choose QQQM. It's like the set it and forget it ETF, cost-efficient, diversified, and reliable. Here's why. The world is entering a massive digital expansion phase, AI infrastructure, chip demand, cloud services, data analytics, and cybersecurity are all seeing explosive long-term adoption. VGT is at the center of all of it. Sure, it'll be volatile, but in 2026 and beyond, volatility is the price of progress. And I'd rather ride the waves of innovation than watch from the shore. Even if you start small, VGT gives you exposure to the next decade of technological transformation. It's not about timing the market, it's about owning the future. So here's the bottom line. If you can stomach short-term swings for long-term exponential growth, VGT is the ETF to own in 2026. If you prefer stability and strong fundamentals, SPMO is your disciplined growth pick. If you want something simple, balanced, and cost-efficient, QQQM gets the job done beautifully. Whichever one you choose, remember this. The best ETF is not the one that looks perfect on paper. It's the one that matches your conviction, your patience, and your financial horizon. Invest smart, stay consistent, and let compound growth do the magic.